Phil Muscatello and Finpods are authorised reps of Money Sherpa. The information in this podcast is general in nature and doesn't take into account your personal situation. Shares for beginners. Weekend Watchlist.
G'day and welcome back to Shares for Beginners Weekend Watchlist, where we take a close look at an individual company that you may wish to consider for your watchlist. It's not a recommendation to buy, but a way for you to learn how Stockopedia screens for value. Joining me today is Elio D'Amato, and we're talking Wesfarmers, ASX code WES. So, Elio, tell us the story of the company behind the Saturday morning sausage sizzle.
I'm going to talk about this company because really it epitomises why I love the market and why I love Wesfarmers. And it's not because after I do this podcast, I'm going to drive down and wait in line to buy a screw with a massive margin on it, or that I'm going to take home one of those overpriced sausages that you mentioned, Phil. But of course, it's all for charity, so who am I to snuffle at that? But at the end of the day, it reminds me that stocks are not inanimate three-letter codes floating around in space waiting to be snapped up in some form, in some type of lotto, as it were. But really, they are real companies, right? They're generating revenues, they're paying expenses, they're employing your kids or your grandkids in many cases. You can touch and feel the business. You can stick your head out the window and really get a gauge as to how things are going. And whilst Bunnings, yes, is a big part of the Wesfarmers empire, it's also other parts too which make up this great church. And I think that it's well worth spending a bit of time to talk about it because it's such a familiar business to many of us. But more importantly, it's something we can actually do, a do-at-home or do-it-yourself style investment on in order to get an understanding as to whether this is a good investment or not.
And this is categorised as a consumer staple stock, isn't it? Well, obviously it's a conglomerate, so there's going to be a lot of aspects to it, but a lot of it is the consumer staple sector. Is that correct?
Yeah, that is correct. And I think it's probably where a lot of the junior analysts get stumped up first because we often look at the portfolio and it's chock full of all these retail businesses like Bunnings, Kmart, et cetera, et cetera. But in essence, what they are is they're a company that has assets and looks to offload them. I mean, that we need to remember that they spun off the Coles business. They used to have the holding in regards to that. They also, for those that have been investing long enough to remember the Curragh coal mine that Coronado bought back in 2017. And they've made recent acquisitions like API as well. There was also Kidman Resources back in 2019, which has become Westchef, and we'll talk a bit about that in a moment. But yeah, you're right. If you look at the business at a top level, you've got to admit it's retail. I mean, seriously, Bunnings makes up, I think it's around 40% of the total group sales. Kmart is actually not that far behind it, and it's quite rapidly growing, funnily enough. But, the businesses themselves are very much mum and dad retail businesses, but ultimately it is an investment vehicle and an investment conglomerate. And I think one of the things that they've mastered, whereas we often suffer as investors, is we do fall in love with businesses, whereas, Rob Scott, as the head of the business, is very much focused in maximising return and then ultimately realising that investment for shareholders. And I think there's a strong emphasis in regards to shareholder returns whenever you read through their literature. There's plenty of it. But again, if you think this is a one-trick pony, I think you're wrong.
So what has been the effect of high inflation on the sector that's been affecting this stock?
That's a really good question because, the impacts are obvious in regards to the cost of everything going up. So when you look at something like Bunnings, which is the major part of its overall business, that's obviously going to have an impact on the bottom line. The costs of doing business are going up. The company is very much focused on automation and trying to streamline its processes, something we'll talk about in a moment. But obviously, inflation's not good, and that had been a bit of an anchor for quite some time. But then the company has come out and confirmed that strong growth achieved at Kmart, as one would assume, doing some of that heavy lifting in regards to costs. And whilst it's also more expensive to run that business, they now manufacture and build quite a bit internally, and they've done quite well on the back of it, once again proving that the penny-conscious consumer will always go for good and outstanding value. Where I'm really excited, I think, is I look at that Wesfarmers Health division. I mean, we're talking about a division whereby it's the third highest in regards to sales, yet it's the second lowest in regards to profitability. And I tell you, any hedge fund in their right mind would see that and just be licking their lips, because they'd be thinking that that could definitely improve profit extraction with regards to those businesses. And I think we're going to start to see that. And, you know, they made that acquisition of Silk Lasers not that long ago. They had to bid a little higher than what they had prior. And one would assume that is ultimately so that they can build out this wealth division. And I think we've also learned that once you own land or once you have access to the land, that's a key aspect of success. And I think we'll discuss another elephant in the room in a moment. But when you've got an existing business, strong omni-channel with regards to, you know, being able to purchase online, their acquisition of Instant Scripts, which also further supports that business, I think there's a real great opportunity to be had there. There is a small part of the business, though, Phil, that, you know, we do need to talk about. It's somewhat protected from inflation to a degree because it is more of a price taker rather than a price maker. But nonetheless, it does suffer a bit, and that is WES. CHEF standing for Chemicals, Energy and Fertilizer, of course, and it's that division of the business. And with global commodity prices really falling off a cliff over the last 12 months across all those assets, as it were, that they basically run, then unfortunately that is a drag on the business. And less because inflation is bad because the cost of doing business goes up. But if your price of your commodity goes down that you're trying to sell, then that's going to have a major impact on your overall business. And we've seen that as well. So whilst, yes, inflation has had an impact on the overall company, they've managed that to date so, you know, quite well. And I think it's also, again, a reminder to investors or those that haven't been investing for more than 10 plus years that the current environment we're facing is actually quite normal. I mean, anemic interest rates is something that was actually not normal, yet we're all decrying and hoping that we'll go back to those emergency rate levels, but we won't. And I think what we're seeing in regards to inflation and interest rates and all that sort of thing is really quite normal. And this is where the Rob Scotts and the countless other CEOs in the world will really earn their money because they're operating in pretty much a standard and normal environment. And in our view, with regards to Wesfarmers, they're doing quite well.
So how about momentum? It sounds like this one's a star in the momentum field, and it qualifies for the 52-week high momentum screen. Tell us about momentum, and in particular in this company, and how Stockopedia users can use a screen like this to identify stocks with a market tailwind.
Yeah, excellent question, because that's really what we are. We are a tool, not a tip sheet. So this is for conscientious DIY investors who want to go in there and really understand what it is that's driving their business at the moment. And you touched on momentum, that we rank it quite highly at around 95 at the moment. So it's in the upper echelon, and it'd want to be. And two elements of that momentum, and I'll break them up into two pieces, is one is obviously price momentum. And that's what most of us would most likely reflect with any company. And that for Wesfarmers has been incredibly strong. I mean, we're talking about performance outperforming the market over the last month by around 9%, over 3 months by 5%, over 6 months by 22%, and over the entire year by 35%. So if you accept the fact that it's been a strong year for the market, well, Wesfarmers has actually been stronger, and its price is actually not too far from its 52-week high, as this recording is currently underway, even with the little market hiccup that we had recently. And the price is obviously well above its 50-day and 200-day moving average. So in regards to momentum, we're seeing a range of ticks, and obviously that price is supporting a good score there. But as I mentioned, that's only part of momentum, because the second part of momentum is actually earnings momentum, or what we would call earnings revisions. And to be honest, with regards to Wesfarmers, it's pretty hard to find anyone that would necessarily suggest that what the outlook that Wesfarmers has is not all that positive moving forward. And I touched on, well, they've recently had a strategic day to analysts, as it were, which is an enthralling 95-page PowerPoint presentation that, seriously, if you have trouble sleeping at night, it's well worth the time to go through. But obviously that touches on a lot of the drivers in regards to the business. And there were key themes in regards to, one, expanding the existing operations, and two, obviously automating as much as they can in order to keep margins at a low. Like, for example, their radio frequency identification system that they have helps with inventory management, demand forecasting, product availability. There's a whole range of different things that it does. And if they improve buying online, which they have been doing progressively, and a bit of a elephant in the room again, and we'll talk about in a moment, and spending on customer service. And Phil, I'm sorry to take over, but look, I can still remember as a young analyst, well, probably not that young, but nonetheless, I had a chat to Michael Luscombe. Now, if that name sounds familiar, that's because he was CEO of Woolworths back in the day when they launched what came to be known as Masters. And Masters at the time was pretty much a category killer. It was designed to take on Bunnings and basically have some of the large pie that it was. Now, of course, Bunnings operates at around an operating margin of around 10%. To me, it hardly shoots the lights out in regards to an obvious opportunity. But nonetheless, Michael was a tinkerer at home and very much was focused in regards to this. And I remember one of the key things he said at the time was when we said, he was trumpeting the customer service that was going to be available at Masters. And he basically said that, we're going to be better because the guys at Bunnings are basically all out the back doing those commercials. You know, the ones we still hear all the time, 10%, et cetera, and talking to the camera and all that. They haven't changed that in all that time. So back then they were doing those, and apparently that's where all the staff were doing those ads rather than necessarily helping customers. But of course, we know there's many elements in regards to running a business like Bunnings, and unsurprisingly, Masters eventually failed and disappeared. But nonetheless, they are going to spend more in customer service, and they are quite knowledgeable, and they are building that, particularly as they grow their trade part of their business. So they've definitely got an eye in regards to that, automation and managing margins. And almost I've forgotten where regards we've gone with this, but I really do think that they are quite shrewd operators. And again, if you ignore them, you're going to really suffer. And momentum really, actually, that brings us back to momentum, because the price just reflects the fundamentals. I mean, you get over enthusiasm and over pessimism in the market, and the reality is somewhere in between. And often what can happen is the price runs ahead of the fundamentals and the fundamentals catch up, or alternatively, the price goes down and then the fundamentals eventually catch down, or the price comes back to the fundamentals. And that's not really the scenario we want. In fact, we've got very much the first case here with regards to Wesfarmers, and analysts have realised that, and their earnings have pretty much remained stable, if not a little bit up. But obviously, in the four walls, as they say, they're all quite optimistic in regards to this business, and the price reflects that, and hence why it comes up in that momentum screen. All this stuff that we talk about, Phil, is stuff that we then have to go in. You can ask us, et cetera, whatever the case may be, or do your own research in order to find this out, because it's all publicly available information. There's nothing on the inside that we know, and it's all available out there. So in effect, what we're doing is we are assessing all that information to make that call, as the analysts do with regards to momentum. So when you combine price, when you combine analyst revisions, the overall momentum for this score, or for this business, is actually quite high, as I said, at that 95.
Are you picking shares on gut instinct, buying on press tips or rumours? Do you struggle to find the time to keep up with the research and analysis that goes into evaluating potential stocks? Stockopedia are pleased to offer a special deal to listeners of this podcast, a 14-day free trial and a 10% discount on the first year of membership. Sign up now at y.stockopedia.com/SFB. There's no better time to access the most comprehensive, easy-to-use investing toolbox for DIY share investors. 10% off, 14-day free trial and a 30-day money-back guarantee. That's y.stockopedia.com/SFB. Well, let's have a look at the fundamentals, and I'm presuming that it's going to be quite an effort, especially with those 95 slides. I guess that's all the particular divisions of the company. Is it hard as an analyst to find out all these numbers and put them all together in one complete package?
Look, if you were going to build out a DCF and do hundreds of lines that cater for all their divisions and the like, and you're going to forecast their future cash flows into perpetuity and discount it back to a present value today, then yes, it can be quite difficult. But the good news is for many investors, it actually isn't that hard. And I think when standing on the shoulders of investing giants, there's a whole range of different ratios and numbers that you can use in order to assess the group as a whole. And the benefit of being a conglomerate is that there can be good performances in some, like I said, with Kmart and with Bunnings, and that can offset some challenging times with regards to Westchef and their online business Catch that they've had a lot of trouble with in recent times. But the company still holds hope with that, particularly in regards to its omni shopping experience and channel that it wants to build. So I don't think it's baby out with the bathwater, but I do think there's been asset write-downs, and I think there's probably going to be a few more to come in regards to that business, but it's only a small part of the overall company. But when you look at their entirety, so when you look at the collective of the business, we talked about momentum, and that ranks quite strong. But the reality is actually not its strongest ratio, as it were, or its strongest ranking. Its strongest ranking goes to quality, which is what you'd expect from a company achieving a return on capital of over 20%. They've got return on equity of over 30%. They've got operating margins close to 10%. Their Piotrowski score, or their F score, as it were, also ranks quite highly. They've got very low financial risk in terms of the Altman Z score. And when you look at the cash conversion as measured by Beanish and his measures, then we're looking at low cash manipulation, which therefore means that a lot of that profitability is being transferred to cash and then ultimately as investors into our back pocket as dividends. That dividend yield has obviously been coming down, notwithstanding dividends have been going up, and that is purely a reflection of the price going up. So value is where it's challenged a little bit, and I think it's fair for me to say that. Look, you got to pay to play if you want Wesfarmers, that's for sure. I mean, we're talking about a stock trading on a forecast PE ratio of 28.9%. They're on an EV to EBITDA of 18. So this ain't cheap. And I think if you were to find another company somewhere, I think you get 10% off the Bunnings. But anyway, I'm going to sort of going off the path here. But in regards to this company, we know value is hard, and it ranks at about 30, and that has actually been coming down. But again, that is because of the inverse relationship that value has with price. So as far as momentum goes, as we touched on earlier, you want that to be going up, and therefore, because that means you become wealthier, of course, and therefore that ranking then lifts, and that's why it has that high ranking as opposed to value. But I think investors would very much want to make sure, they can't be fooled in thinking this is a one-trick pony. There are quite a few, I suppose, strings to this bow in regards to their performance, and it's definitely well worthwhile looking at. But I think looking at them as a conglomerate, just like our portfolios, it's what we should be doing as well. Not all our stocks are going to be 100% winners, Phil. There's always going to be stocks that underperform at times. That's why we have a well-diversified portfolio, so that during times where one stock does well and the others do poorly, then in another time, another one of those poor stocks, well, that actually does well, and the one that's done well actually takes a bit of a breather. There's always a bit of yin and yang and a bit of give and take, and that has definitely been the case with Wesfarmers. Although that said, in terms of operations, they've been doing quite well. And yes, you can simplify what is often a very difficult process just by looking at the numbers in our view. And in regards to Wesfarmers, we rate them quite highly because overall, especially when you look at those strong momentum and strong quality scores, even with the poorer value score, it ranks as 83 overall, which still puts it in the top 20% within the top 400 companies on the ASX. So it's definitely nothing to be sneezed at. And I think we just need to remind ourselves again that if you just scratch a little bit below the surface, you can see some really good reasons to invest in this business, even though the top line numbers actually look quite good.
We're recording this episode on August the 8th, and we're coming into reporting season. Is there anything to be careful of about this particular company? Because it hasn't reported yet, has it?
No, and I mean, that's always a bit of a challenge come reporting season, looking at these businesses, particularly fundamentally. I mean, momentum less so, because obviously price and analyst revisions are always occurring, as it were, irrespective of when a company reports and the like. There's always a bit of tinkering around the sides there in that regard. But when you look at things like quality, for example, that is heavily dependent in regards to reporting season. And obviously, with all stocks that we're discussing leading up to the earnings season, we always need to have an element of a caveat there. But it does give us, that extra bit of confidence that the company has definitely stuck to its guns in regards to its strategy day update. I mean, that was only back in May, so it's not that long ago in regards to providing it. So if something would have blown up or changed significantly within that business, the company is required to declare on the ASX that that's the case. And this is really an example of no news is good news. So, we haven't had any downgrades, so that's got to be somewhat good. But you touched on it earlier, Phil. One of the key risks is in regards to inflation. I mean, the rising cost of doing everything. It's more expensive to run a business, and it's more expensive to go out and buy a screw and a nut, et cetera, et cetera. And how companies like Wesfarmers manage their inventory, ensuring that they're able to keep their stock moving off the floor and do so in an effective cost price while also being able to pass on a moderate price rise to clients is obviously something that they need to be focused on. And I think we'll be looking there in regards to that when they do release their full year result, because let's face it, right? Margins are the great profit expander. I mean, what is it? Sales of vanity, profit is reality, and cash, well, that's king. Now, you obviously then break that down and get to that bottom level. And the key part of that is just in regards to how much cash is coming in versus how much is going out. And therefore, we only get that real level of insight once a company fully reports. And that is going to be key and integral in regards to Wesfarmers. But I think a second risk that we do need to be aware of is in regards to, being a conglomerate, they're always going to be exposed to assets, and, they do have a good track record, but they aren't scientists. They don't get it right 100% of the time. Sometimes they do get a few errors. And I touched on that catch business, which has been a little bit of a challenge in regards to the overall company, notwithstanding that its role within the overall portfolio. So when you include Bunnings, Kmart, when you also look at their rewards business and the like, they're looking to expand out there as well. I mean, for example, you can use Flybuys now in a Bunnings store. These sorts of things, they see catch as being a key tenement in regards to that technical back end that we don't see. We can't touch and feel, but they see that as quite valuable, particularly as, things like that wellness market, the healthcare I talked about, and they're expanding into that and growing that and all of that sort of stuff, and being able to purchase that all online and all link up. They see that as quite solid infrastructure. So it doesn't necessarily mean that every acquisition they make is good. And WesChef, I mean, right, again, heavily focused towards, green energy as well as things like fertilizer, et cetera. Well, seriously, you can't find any analyst on earth that thinks that there's a good outlook for those businesses at this point in time. So that is a division which is a drag on the company, and therefore they do need to be cognizant of that and basically sell to analysts why they're still investing all the money that they are into these sorts of businesses. Notwithstanding they're still profitable, their margins have been absolutely smashed. But of course, that's cyclical, and there's a whole range of other things that we can't talk about in this podcast. So I think overall, yes, there's inflation is a key risk. And yes, they don't always get it right. So if you just acknowledge those two risks whenever you invest in a conglomerate like Wesfarmers or any other that's out there, then that'll help further provide you with an element of confidence. But I mean, look, let's face it, they've got a strong balance sheet, as alluded to by that low credit risk score that they've got. They're going to be working on their operating model in a bit more detail to look to further automate that even further. They're going to possibly, do even more investment either in their existing channels, which they still think there's some solid growth to come from, but also they might even branch out into a new investment that we don't even know yet. But they say, or if you can believe Mr. Scott, that they say they will obviously run the rule over it to make sure that it represents value for investors over the long term and make sure that shareholders get rewarded along the journey. So, and I don't know if you've seen it, Phil, but, they've got a new pets division, for example, in their Bunnings stores, which seem to be going well. The Anko brand within Kmart is still growing and doing quite well. Their divisional data and digital investments that they've been making are still growing, which is good, further supported by their loyalty and rewards. And yes, WesChef, notwithstanding that it's been cyclical and suffered in recent times, if you assume that the good times will eventually come back, well, there's further expansion there to be had, as well as further decarbonisation efforts, which could further support the business. So for those that can look at a stock price longer than their nose or further out than their nose, then, and us being Italians, Phil, that's going to be quite a lengthy period. And then someone like a Wesfarmers is worthy of considering because they've got the numbers to back their story up.
Well, Elio, I guess we'll be catching up at the sausage sizzle maybe one of these days. We can meet otherwise in Sydney or Melbourne. Thanks very much. That's a great overview. Thanks very much, mate.
No, thank you very much, Phil.
Thanks for listening to Shares for Beginners. You can find more at sharesforbeginners.com. If you enjoy listening, please take a moment to rate or review in your podcast player, or tell a friend who might want to learn more about investing for their future.